I'm Dan Fitzpatrick at stockmarketmentor.com and optionmarketmentor.com. Hope you'll check both of those out. Look, I want to talk about Bollinger Bands. This is a very, very popular indicator. And the reason it's popular is because it works. This is an indicator that works. It gives you a real sense of price action, direction, where trends are, when the trend is weakening, when the trend is strengthening, things like that. But they're also pretty misunderstood. You know, buy when it's outside the lower band and sell when it's outside the upper band. That's pretty simplistic. So I want to go into some detail here and hope that this will help you understand how to use this very, very popular and useful indicator, originated by John Bollinger, and he wrote a book, Bollinger on Bollinger Bands, which is really the penultimate Bible on Bollinger Bands. So I definitely recommend you check that out. Here's the Reader's Digest version. Okay, what are they? These are adaptive trading bands that reflect changes in volatility and provide a clearer picture of the true extent of price movement. Think about them as trend lines. They're adaptive trend lines with a volatility component. So rather than be straight up, there's an upward channel, or straight down, or trending down, there's a downward channel. Instead, you get these Bollinger Bands that flop all around. It seems like they don't make much sense until you really understand what they are. So again, just think about Bollinger Bands as trend lines defining support and resistance. So let's take a look here. Okay, calculating them. They're used, it's standard deviation. It's a statistical methodology, a very, very complex calculation. A lot of times when I teach this indicator, I show a big chart or a big, graph of exactly what standard deviation calculation is, just to scare people and tell them then finally, oh, guess what? You don't need to know that. I'm going to spare you the details on that. Instead, let's just say that it's a statistical calculation to measure dispersion. In other words, how spread out, and we're talking about just closing prices in the market, not not intraday highs or lows or averages or anything like that. We're just talking about closing prices. How spread out are they around a specific moving average? And typically you use the 20-period moving average. You can use the 50-period moving average. You can use the 200. You can use whatever period you want. I like to keep it straight and simple, 20 periods. So if it's a daily chart, the 20-day moving average. If it's a weekly chart, the 20-week moving average. And so you look at that moving average, and again, moving averages can be moving higher, they can be moving lower, they can be trending sideways. All we want to know is we look at that moving average and how close or far away are all the closing prices relative to that moving average. And just, this is obvious, but sometimes it's only obvious after it's explained. If it's a 20-period moving average, all we care about, the only thing that the bands are calculated on, is those last 20 periods, those last 20 data points. So as each day, if we're talking about days, and I'm just going to revert to that, days. The last 20 days, as we get a new day onto the front end, the 20th day pops off the back end. So it's a walking set of prices. And so how far apart or close together are most of those prices? The larger the standard deviation, the greater the containment of prices. Or put another way, these Bollinger Bands are dynamic. They spread out. They get narrow. That's called a volatility squeeze. They get wide. That's called a volatility expansion. Narrow again. And so why do they do this? Because they adapt to the prices. If prices are all over the place, just all over, then the Bollinger Bands widen out, because they got to contain those prices. If the prices are really kind of chopping around in basically the same level, the Bollinger Bands narrow. Why? because they don't have to be wide. All they do is they want to contain the prices. They want to wrap themselves around the prices, and that's why we get this, again, this widening and narrowing of these Bollinger Bands. So let's look at it, and I'll get to charts in just a minute. I got to ask you to bear with me on some of this so you can truly understand what's happening here. Okay. One standard deviation. This is the midline right here. This would be the value of that 20-period moving average. This is one standard deviation above. This is one standard deviation below. Most of the prices are going to be hovering right around this middle, this midline, the 20-period moving average. Well, in order to contain, if you just have one standard deviation, you're ultimately going to contain only about 68, we'll call it 70% of the closing price data. So there's going to be prices that are outside the bands quite a ways, frankly, to a point where they really don't do you much good. Two standard deviations, that's the normal. Statistically, they're supposed to contain 95% of the closing data. Actually, and this is a study done by John Bollinger, they contain about 90%. So about on a two standard deviation setting for Bollinger Bands, about 90% of all the closes are going to be inside the bands. And this is important because, again, if the prices are all over the place, they're up and down and all around, then those bands are going to have to be really wide in order to contain 89 or 90%. On the other hand, if the prices are all kind of clustered, let me get rid of this here. If the prices are all kind of clustered in one little general area, then what happens? Those Bollinger Bands don't have to be so wide in order to contain 90% of the prices. Now, if we go out to three standard deviations, and this is a whole different trading methodology here that I talk about at Stock Market Mentor sometimes, and certainly in my live workshops. Three standard deviations. Those, when you got these Bollinger Bands that are really wide, three standard deviations, they contain 99% of the closing price data. Only 1%, one out of every 100 days statistically, is going to be outside the bands. So by the way, when you see that 1%, what do you think is probably going to happen maybe the next day or the day after that? Well, that price is going to fall back within the Bollinger Bands because statistically, that's what it does. So at this point, and by the way, that's not a simple trade either. You can't just say, oh, okay, well, if the price closes, I use three standard deviations, a setting of 3 as opposed to 2. If the price is above the upper band, that means I get to short the stock. If the price is below the lower band, then that means I get to go long the stock because the stock's definitely going back up. No, it's more complicated than that because of the width of the bands. They're adaptive to volatility. So certain conditions, this is absolutely a winning trade. Up above the third standard deviation, upper Bollinger Band, short that stock. Down below the third standard deviation, lower Bollinger Band, go long that stock. But other conditions have to exist in order for that to be a very, very high probability trade. But that's for another video. Here, we're just looking at the basics. Now, bear with me here. So this is how we look at them. Bollinger Band calculations, 20-period moving average. That's the midline. 20-period standard or simple moving average, 20-period simple moving average plus 2 standard deviations. That's the upper band. 20-period simple moving average minus 2 standard deviations. That's the lower band. And so the prices, ideally, 90% of them should be within this range here. Now, here's where it really gets interesting, and this is why you have to know this. It's a relative indicator. On an absolute indicator, a nominal indicator. It's easy. $45 is always higher than 44. Sometimes when you're in maybe first grade, that's not always the case, but for most of us, we get to a point where we know if a stock is $45, that would be $1 higher than 44. $100 is always lower than 110. Bollinger Bands are different. 45 actually might be lower than 44. 100 might be higher than 110. Why? Because we're gauging high and low relative to the Bollinger Bands, relative to that. What's high relative to the Bollinger Bands? What's low relative to the Bollinger Bands? Absolute, it's just easy. Count from 0 to whatever you're at, and the number that you come to sooner, that's lower. Okay, it's really easy. So we're really talking about relative here. What are prices relative to these Bollinger Bands? So we'll look at it this way. Higher highs or higher lows. Absolutely. On an absolute basis, these are higher highs, these are higher lows, until finally there's a break here of the trend. Now, we put in a 20-period moving average in this same chart. That's basically right through the middle. Okay, but there is some volatility here. You can see the moving average moves up and down just a little bit. And so the upper Bollinger Band could be constructed this way. Now, look how close this last high is. Remember, higher highs. All of these are higher highs. But look how close this last high is to the upper Bollinger Band. It's about right on the money. The next high, it's higher than the last, but it's lower relative to the Bollinger Band. The next one is higher than the last. So we've got this trend line here of higher highs. On the Bollinger Bands, though, you can see they're actually lower highs, lower relative to the upper band. Here, basically right on the money. Here, a little bit below. Here, a lot below. So if you weren't looking at this in the context of Bollinger Bands, but were instead just looking at it as on a price, you would be surprised. You'd be surprised when this stock broke trend. But if you look at it relative to these Bollinger Bands, to the upper band, you would see that we've actually had some pretty fair warning that the price was deviating away from these highs. And so you get basically an early warning sign that there's a problem with these bands. Now, if we look, or with the price. Now, if we look at the lower Bollinger Band, we put this in there. Again, higher lows. What's happening though? You can see it. Relative to the first one, the price is well above the lower band. That's a good thing. Next one, the price is closer to the lower band, so it's kind of lower relative to the first one. And then next, we've got one where it's just about right on the lower band. So this is, again, one of those situations where, you know, the price is doing one thing, but relative to these Bollinger Bands, what would normally be seen as higher lows are actually lower lows relative to this lower band. Now, we put them both together, and you can see what's happening. The price, even though it's higher, has actually been dropping away for a while. And even though the price here, even though it's higher, has actually been coming in closer to where it was going to break down. So you would have had, again, an early warning sign that this price was going to break down if you had been looking at this in terms of Bollinger Bands. Now, let's look at a couple charts. Now, here's an old chart of Google. Where's the, you can see the stock trending down. Where is the first higher high? You got to look and say there. This is all within the trend here, downtrend, and then finally, oh, we get a higher high, we buy the break, or we buy the pullback here, and then we ride this on to victory. But if you instead slap some Bollinger Bands on there, what you will see is relative to the 20-period moving average, it had been banging against the 20-period here. This was your higher high right here. Even though it still conformed to this trend line, this gave you the early indication that this stock was turning. It gave you an early indication that this closed above the 20 period moving average. Well, that was different. Now you get the pullback on the first sign that the stock's moving higher. That's when you buy the stock. And while I'm at it here, look at how this was behaving relative to the lower band. Stock had been basically walking down along the lower band, just moving, staying right inside, but on the lower end of it. Suddenly, the price starts to trade above the lower band. Finally, on this pullback, the stock was noticeably above the lower band. A totally different characteristic than we had back here. So this is really how you look at these Bollinger Bands. By the way, just look and see what's happening here. Upper band well above these prices. Lower Bollinger Band, that was tagged there. So now we're right in between. So let's just kind of do a little quick theoretical trade here. You know, when you buy this stock is not when it just breaks out above this level, above this last resistance level, but when it actually breaks out above the upper band. That's an indication that once again the price is changing, the price action is changing. Why? Well, because the last time the stock hit the upper band and actually exceeded it was here. Ever since then, it's never come and threatened the upper band. So when the stock actually pushes above the band again, that gives you an indication that the trend is continuing. Now, let's look at the lows. Here's a chart of floor. Where's the higher low? The first higher low? Well, that would be here, wouldn't it? Because we can see, you know, low, lower low, lower low still. Well, you know where I'm going with this. Now we put on these Bollinger Bands and you can see that this was actually a higher low, a higher relative low. An absolute low, nominal low, price low. Certainly this was a lower price. But relative to the Bollinger Bands, this was contained by the lower Bollinger Band. This was not. So this was your indication. This higher relative low was your indication that this downtrend in floor was ending and it was time to start going long. Close your shorts, start to go long. If you don't do that, you're going to lose your shorts, or at least lose your shirt. What you do with your shorts, I don't really care. So let's look and see how we could have traded this back in the, the early days of the new millennium here, when the market was really in the toilet. I made these trades. A lot of people did if they knew how to use these Bollinger Bands. You can see the three big lows here. Okay, just simple price action. Now let's look at them with Bollinger Bands. We're zooming in here a little bit. Look at these three lows relative to the lower Bollinger Band. Well below the lower Bollinger Band. Here, okay, a lower absolute or price low, but a higher relative low relative to these Bollinger Bands. Now, here, well, it came back down below the lower band, right? Yeah, but we got a higher absolute low or price low than here. So you can see you can use these bands, you can look at them and find out some things about the price movement of a stock or an index or whatever that you wouldn't be able to see if you just looked at the price itself. So what I'm suggesting is that you use these Bollinger Bands in conjunction with just looking at the price movement. If you could use both of these together, you are going to have a powerful trading tool, a very powerful trading tool. I promise you, you're going to have a better sense of which direction price is going before the other guy, and it's going to help you get into trades earlier and stay in trades longer until it's finally time to get out. And so now we zoom back out and we look and see again what this bottom was like. Lower relative low, higher relative low. I'd say higher still, or at least an absolute price low right here. And then you can see what happened after this. So when you see these big, massive bottoms, look at them in the context of Bollinger Bands. So I'll end with this. I'll take you to a chart of Apple, everybody's favorite stock that they love to love at one point and then they love to hate. So what are we doing here? All right, this video I'm doing at the end of the day on Friday, March 15th. I'm looking here and you see these lows. Look, well below the lower Bollinger Band. Oh, a lower low still, absolutely. In relation to price, yes. In relation to the Bollinger Bands, not quite so much, but I'm getting nitpicky. Still extended below the lower band. So I would say this low, again, I could make a case for this being a higher low relative to the lower Bollinger Band, but come on, that's results-oriented analysis. It stinks. It's below the lower band. This more so. But when we look at the weekly chart, you get a better sense of what's happening. Now look at these. I'll zoom in here. By the way, this is my head and shoulder neckline that I've been talking about for quite a while, like since it first started forming this thing. But look at the last three lows here. Look at the low relative to the lower Bollinger Band. Well below that level. Basically established the neckline. Look at this next low. Basically within the lower Bollinger Band. This next low, which by the way was much lower in price than this one. This next low, lower absolute low, lower price low. Within the Bollinger Bands, just about the same. Just about the same as this one. So we definitely have within these Bollinger Bands let's just say the downtrend, this series of lower lows is not being maintained. It's starting to get a little frisky. Now here, this last one, assuming this is a low, this is well above the lower Bollinger Band, even though this low here is lower than that one. So we have a series of lower price lows, but within the Bollinger Bands, these are actually higher lows. And so this is giving you an indication that the downtrend in Apple has just about run its course, and the way you would trade this stock would be you see how the stock moves higher, see if it moves closer to the 20 period, here the 20-week moving average, and then the first pullback, if it's higher than this one, that's when you buy. So you don't catch the exact bottom, but you see what's happening. You wait for this pullback. You look at it in relation to the Bollinger Bands as well as these other prices. Bam. You buy this stock. You're not in at the exact bottom. You're in at a little bit higher price, but your risk is lower and your confidence is higher. So anyway, listen. Hope that this has helped you understand Bollinger Bands. I basically do all my analysis on stock and option market mentor using Bollinger Bands, and you'll learn a lot more if you're watching these. If you're watching my nightly videos and my weekend videos. So if you want to learn more about those, then definitely encourage you to check out those sites. Okay, I'll see you next time.